Hello, it's Mark Albert. Thanks for being with me today. Welcome to my YouTube channel. Today, on April 24, 2019, the Bank of Canada made their interest rate announcement. We're going to look at that. We're going to see what the announcement was. We're going to talk about why they made that announcement, both globally and domestically, what they feel is going to happen in Canada this first half of the year, and that will change in the second half of the year, according to them, according to the numbers as they see it. Also, I want to talk about something towards the end of this video, which I think is a game changer, could potentially seriously negatively impact the Canadian economy if it doesn't improve, and depending on the overall economic activity. So if Bank of Canada update is something that is of interest to you, please subscribe below because the next one is May 29, and I'll be updating on that one as well. So let's get into this right now. So the Bank of Canada decided to maintain the rate. So they're maintaining it at 1.75. Interesting enough, last time they increased it was in October. And there's like the fourth one since then. They had it in, December, January, and then in March. And here we are in April. So this is the fourth one that they're maintaining the rate. So the world and Canadian economy, according to the Governor General, the governor is in a detour. Now, they didn't say it in the official press release, but when they were interviewed and they met with the media, he said that. He said it's a temporary detour. What he meant there is that for now, the economy's not doing the best, and then it's going to recover into towards the end of the year, as we move to the end of the year. So some reasons for maintaining the rate. So globally, they found that globally, the economy growth has slowed, and that's in keeping with what the Bank of Canada thought it was going to be. If they went back to January, what they were anticipating is slowed down in light of that. So also, there's ongoing uncertainty with trade conflicts. So it's impacted many countries, and it's had a negative impact on business activity. And it's been a slowdown. And it's not just Canada, but there's 47 countries that are also impacted due to this slowdown. And so it's had a widespread impact. So what I think they were alluding to in the press, in the release with the media, was that, if this improves in terms of trade conflict, then there's enough sound activity going on, fundamentals in the economy, that the economy can just chug along beyond that. So domestically in Canada, the growth during the first half is expected to be slower than what was anticipated back in January. If you recall, if you go back to October, the Bank of Canada, they thought things are going to really do well. They were anticipating 3 increase rates on their interest rate in 2019. And we haven't seen any of that, and we probably won't see any of that all year. So then later in last calendar year, things really started slowing down, and then since then, they haven't really picked up. So also domestically, oil price in decline, and there's ongoing transportation constraints that have impacted investment and exports in the energy sector. So they're not really building pipelines in Canada, and companies that are doing oil in Canada aren't really developing, aren't investing in more ability to do that. There seems to be kind of enough supply, but we're not able to push it out to global markets. We're not able to really sell it. Of course, the price of oil, we're not as competitive in Canada compared to the global economy, and that's also part of this situation. So also in Canada, not just in the energy sector, but outside of energy, investment and exports have been negatively affected by trade policy uncertainty and global slowdown. So that's also played into it. Weaker than anticipated housing and consumption also slowed down. Now, it's interesting, housing, so the housing market, not the typical growth in housing that you would anticipate as we are in a spring market right now. And in terms of consumption, so consumer spending is not really great either. And I think one of the reasons there is that maybe the debt to income ratios are a bit high. People a little overextended on the debt, and with some of the negative things going on in the economy, maybe they're just lacking the confidence to purchase. So the Canadian economy, the economic activity is expected to pick up during 2019. In fact, what he said was in the second quarter, which we're in right now, growth is expected to pick up. But then as we move into the third order, it's really expected to increase that much more. And so the second half of the year he thinks will be pretty good. And then not just the Canadian economy, but globally, they alluded that they feel that the global economy is going to have some recovery in that as well. So overall, the Bank of Canada projects real GDP growth of 1.2% this year, and about 2% in 2020, 2021. So that's their target, is 2%. They try to keep it between 1 and 3%. So they feel that we're going there from a GDP standpoint. So this is one thing I want to address with us, okay? Because I think this is a big issue and going to get worse. So in Canada, the debt to income ratio, what is that? Well, it's the percentage of the gross monthly income, okay? So your gross monthly income that goes to paying your monthly debt payments. So you basically get your income and you get your debt payments, and it's the ratio between those two. And right now in Canada, we're not doing too good right now. So in Canada, it's $1.78 is our debt to income ratio on average, is for every dollar of consumable income. Now that's as per Stats Canada. Now I have a graph I want us to look at. Now hopefully you can see this okay. So the yellow line represents second quarter of 2018. So you'll see Vancouver is well over 200% debt to income ratio. They're the worst. And Toronto, they're over 200% debt to income ratio. And the reason is, I think, is in those two areas of the country, house prices are really high, and people tend to use up the equity in their home to help them with their financial situation. So if the debt to income ratio is really high, then that becomes a problem, particularly if we move into recessionary territory, because oftentimes when people get in trouble, they tend to borrow against the equity in their home. And if they're maxed out and the government stress test on the mortgage side doesn't allow them to access more money, some of them, they may have to step away from their house or sell their house or whatever be the case. So bankruptcy it has really been on the increase with seniors. But if your debt goes out of control, then it becomes very difficult for anybody, right? If you overspend over a too long period of time. So any potential increase or decrease that the Bank of Canada are going to make, these are the three things they're looking for. They're looking at developments in Canada in terms of household spending. So consumer spending is pretty key. So the reason I showed us the debt to income ratio is because if our debt's too high, it makes it hard to spend. And consumer spending of households is a really big part of the Canadian GDP in terms of getting the economy moving forward. All right, so they're going to keep an eye on that. The Canadian and global oil markets is important, so they're going to keep an eye on that. And then the trade situation globally as well. So these are the remaining dates that the Bank of Canada are going to make announcements. So if you subscribe and click the bell for notifications, when May 29 comes, I'll do that one, and then again in July 10 and so on. So listen, hope this is helpful to you. If you have any comments or questions, please put them below for the benefit of everyone. Thanks for being with me. Have yourself a wonderful day, and we'll look forward to speaking with you soon.